Welcome to the Markowitz, Fenelon and Bank, LLP video blog.
So one of the most hotly discussed parts of the new tax law that went into effect in December of 2017 is the Section 198A deduction, also known as Qualified Business Income Deduction, or QBI, as some people call it. In a nutshell, this enables pass-through businesses to deduct 20% of their net income. Pass-through businesses would include partnerships, S corporations, and sole proprietorships. It specifically does not include C corporations, because the main intent of this part of the law was to bring pass-through entities to an even playing field with C corporations after they lowered the corporate tax rates to a flat 21%. Well, the Section 198 deduction is very broad. It covers pretty much any business type. There are certain businesses that are subject to additional limitations. Those are known as specified service trades or businesses, and that includes basically professional services. It'll include accountants, attorneys, anybody in the medical field, which will include doctors, nurse practitioners, PAs, also consulting, athletics. They're still allowed to get the deduction, but once their income exceeds these certain thresholds, the deduction phases out for them. As far as real estate businesses, they're still unable to take the deduction, but there's a little bit, I guess you could say, a lack of clarity in some cases. The IRS has issued some additional guidance on this, but it's not like your typical operating business that it automatically qualifies. You have to reach certain thresholds in order to qualify. You need to be a trader business, basically. So if it's a triple net lease, for example, and you're just basically renting the office space out and you're collecting rent checks, but you're not involved in the day-to-day operations of the rental property, the IRS could say, like, that is not a trader business, that does not qualify. The main limitations to be aware of are the taxable income limits, and that's applied at the individual taxpayer level. So all of your other sources of income will be factored into it as well. So for single taxpayers, it's $160,700 for 2019, and if you're married filing joint, it's $321,700. That's when those limitations start to phase in. So if you have an opportunity you could either defer or accelerate your income or deductions to kind of keep you in below those thresholds to maximize your deduction, then you should do it. It's not always that simple for certain types of businesses to be able to do that, but it's definitely something to keep in mind. And now the limitations that I'm mainly talking about, the deduction, once your taxable income exceeds those thresholds, the deduction is limited to 50% of the W-2 wages that the business pays, or 25% of your W-2 wages plus 2.5% of the unadjusted basis of the assets that you have in service. Now that's a little confusing, I know, but the second limitation, the 25% plus the 2.5% of unadjusted basis, that was basically that was added last minute for real estate businesses who typically don't pay out a lot of wages to employees, and they might just invest like they own their building. So the basis in the building and any equipment that they have in service at the end of the year, that would come into play as far as determining what size deduction they're enabled to take. The Section 198 deduction it's very complicated. I mean, in a nutshell, 20%, you get to write off 20% of your income. However, there's a lot of things to consider. There's no one size fits all for all business types. You really need to consider your entire situation before you make any decisions. You should consult your accountant, and just to make sure that you're doing what's best for your particular set of circumstances.
Thank you for watching. If you enjoyed this video, we invite you to subscribe to our YouTube channel.